Yeah, yeah. Okay. Took a while. Oh, sorry about that. Took a little while to get things underway. It looks like we had a little internet glitch there. It is Friday the 13th, by the way. Apropos, considering the topic that I have to talk about this morning. Here's the thing. I've been, over the past several months, as you probably know, I've been looking very heavily into, or switching the focus that we have here into tail risk strategies. And obviously today is a great day to look at that. But I have some stuff that I want to share with you and why tail risk strategy is really the more logical way to go, as opposed to what everybody else does, the conventional way of trading, which is, for most people, a losing proposition. As you probably know, that 98% of all day traders within any 3-year period are going to lose all their money. That's a fact. And most other traders don't fare much better. The people who are making money are the people who are really pricing in convexity, tail risks, and taking very, very little positions and risk for extreme outsized positions. That's also a fact. So why you're not doing that? Well, it's mostly because you can't see the efficacy in it. It's a tough sell. It really is, because you look at the numbers and everything. You say, yeah, but the expected move did this, and the expected move says that, as if the expected move is in any way some sort of Bible or something. And I'm going to show you why it's not. But in fact, over the past 3.5 years, the market has been telling you a very consistent lie. It tells us every single day how far it thinks it will move. It prices that expectation into the VIX, into the straddle. If you didn't know, expected move is basically a straddle, and where it breaks even on that day will give you an approximation of where the market expects, or it could potentially move. Right? So that's the expected move. But how does the expected move differ from what actually happens? So that expectation is built into every spread that you trade, every price that you look at in the options chain. And every day we accept that as gospel. But I tested it. I took over 2,500 trading sessions of the SPX and VIX data, real prices, real volatility, and compared compared what the market expected to what actually happened. And so here's what I found. Hold on, let me just switch to this. I got an itchy nose. What's going on here? Does that mean I'm going to get into a fight? That's what I always heard. Get an itchy nose means you're going to get into a fight. I'm not a fighting kind of guy, so. All right, let's move to this, but that's not really what I want. I want this presentation, and that is, wow, there's so many apps open here. I want Keynote. There we go. All right, so I whipped this up this morning. What I did was I programmed up a Python script, and I wanted to know what the expected move was compared to actual move. And at first I just wanted to see what it was over the past few days, because I'm looking at some tail risk strategies and I wanted to figure out what was happening. And then I said, let's look back about 3.5 years. So I went back to the beginning of 2022. As you can see down here, 2022 on January 1, to the present day. And I said, okay, let's plot the expected move versus the actual move. And the expected move is the blue line here. And that blue line is where, if you went to your options chain every morning and you looked at it, there's an expected move there. And so that's what that is. All right. And then the moves up and down in black and everything, that is the actual move. That's actually what happened. So you can see that quite regularly it moves above the expected move in red, and in green is the actual move. I'm sorry, the other way around. The actual move is in the black, but the red area is the actual move that went above the expected move, and the green area is the expected move or under. And so what you'll see is that quite often it is just totally blowing away the expected move. That's pretty interesting. So let's take a look at the stats on that. So the days of the actual move are actually 20% of the time it is exceeding the expected move. Now, why is that significant? Because that presents an incredible opportunity. So the market consistently priced in a daily move about approximately $41. That's what I have, $41.57. But the actual move was only $26. All right? That's a $15 gap every single day between what was priced and what occurred. Now, that's not a random error. That's actually structural. The market is overpricing risk daily, reliably, and expensively. But here's the part that matters for tail risk traders like us. 1 in 5 days, 19.9% in actuality, of the time, the SPX broke out beyond the market's expected move. And on those days, the move wasn't just big, it was enormous. We're talking 100, 200, 300 point moves, sometimes more. And they're all in this chart right here. You can see them. Spikes that are up from long periods of calm where everyone is short vol, underhedged, and underprepared. This is where tail risk strategies shine. We're not buying convexity every day. We're not hoping for disaster. We're simply placing small asymmetric bets during compression when the market has stopped paying attention to what it can't see, like yesterday morning, coming into today. When everyone else is focused on decay, we're watching for tension. And when the tension breaks, the payoff is non-linear. That means it's friggin' huge. One breach covers weeks of optionality. What that's saying is that just one of these events covers all the time that you took these small trades where nothing happened. Right? Just one covers weeks of that. That's the outsized return that we're talking about. 2 breaches tilt the entire campaign, and a cluster, that's a year's worth of return in a single sequence. In other words, any one of these little clusters here, and there's actually over here, there's several of them. There's another one, pays for an entire year of your stuff, and every single one of these is an opportunity. All these little spikes above the expected move. It's just that some of them are friggin' huge, as you can see. And back in 2022, it's just a bonanza. So this is not about being right. It's about being positioned when the market forgets how wrong it can be. And what this data set shows clearly is that the market forgets about once a week. So when people say tail risk trading doesn't work unless you catch the perfect move, what they're missing is that the opportunity isn't rare. It's mispriced. The risk premium is fat. The decay is manageable. And the payoff, when timed well, it's absolutely enormous. This is the essence of Fat Tail's campaign framework. When I say Fat Tail's campaign framework, what I'm talking about is my Skool community called Fat Tail AI. So you'll see the link down below. You go to skool.com/fattail. And this is all we do, is just trade tail risk. The rest of the time now within that, and you know that I've been talking about 0DTE, perhaps what you didn't know is, yeah, sure, I'm trading 0DTE. It sounds like the catchphrase. Everybody's doing that, right? But I'm doing it in a different way. I'm doing 0DTE with a fat tail or a tail risk strategy, an out-of-the-money butterfly. It is far more effective. In fact, it is so much more effective that it just blows out all the other strategies because I take very little risk and make great money with extreme low volatility in my returns. That's the difference. All right? So I don't know. I could show you the charts on that too, and I've showed them before. It's ridiculous. With Sharpe ratios above 5, that's not a mistake. I have Sharpe ratios above 5. That is institutional caliber. Actually, it's even above that. So we're not forecasting chaos, let me be clear, but we're filtering for it. In other words, we're filtering out all the times when there isn't chaos. We're not trading daily, waiting for dislocation, not chasing action, holding posture. This is what the data says. If you have the patience to wait, if you're willing to lose small, and if you're in position when the coil snaps, you don't need to be right often. You just need to be there when the structure breaks. Because when it does, the convexity doesn't pay you back. It pays you forward. Right? That's the difference. All right, let's go back to the big head. And what I'll do is I'll show you like my 0 DTE strategy, which is off the hook. When you get into the fat tail, the 0 DT is included there. But I have a coaching service. That's all we do. We just trade 0 DTE and fat tail strategies. And once you get into it, you'll find that, first of all, 0 DTE is a consistent way to profit. It's in the beginning, it doesn't seem real. You say, well, if I put a butterfly way out here, how could it possibly give me anything? Well, first of all, we're playing the optionality, so we take a lot of the small wins as well. And then every once in a while, it gets inside the butterfly, and it's an enormous win. And then we can take that out to different time frames, go out to 0 to 3. 3 to 5, 5 to 10 DTE. That's where some of these bigger trades live. You wait for those big trades, man, they pay off. Bam! Buco bucks. It's incredible. I mean, let's just take a look at this campaign, just so you can... I didn't go into really the campaign part. So, Sigma Drift campaign, which is a 5 to 10 day, right? Yeah, you lose 85% of the time, but you can make a 750% return. Wouldn't want to do that, right? So this is what a typical campaign looks like. Put in $4,000, return 29. That's crazy. It is crazy, but it's because in this particular event, it was taking advantage of some of those tail risk events. Here's a situation where, okay, no events, just a slow, long bleed, right? I think you could take that. The other cool thing is how low can you trade with one of these campaigns? How much money can you start with? Well, it turns out the reason why I choose $4,000 is that the risk of ruin, in other words, the risk of having a bad day or the campaign busting, is zero. It's zero at $4,000. And yeah, you can trade with a smaller account, but you're taking a slight risk that you could get a risk of ruin. In other words, you could lose all your money. But once you get up to about that point, it's like no big deal, right? You could even go down as low as $500 and take a chance. And if you had one good trade, then now your risk goes way down. All right. What this is showing is just sort of a scatter plot of the number of times it actually gets in the money, which is the purple and green area. It's just a distribution scatter plot showing that, man, this happens a lot. A real lot. In fact, it happens about, like what I said before, with the actual data, 20% of the time. Right? I don't know. Is there a more compelling argument than that? Wouldn't you rather, like, sleep at night, know that you're not bleeding away your money, that you're not taking huge risk to make tiny, tiny little profits? Sure, you're getting that dopamine drip and it's coming consistently until it doesn't, and you hit one of these events, and it wipes it all out for weeks. And then you go into apoplectic shock, wondering what the hell to do. We never get into that. Ever. Ever. Right? While you're running around like a chicken with your head cut off and saying, man, I wish I got that move if I'd only got it. We're the ones catching it. You are our liquidity. I'm just letting that sink in. Let it sink in. Just breathe it in. Let it come in nice and easy. You can do it. That is what fat tail trading is all about. We're the guys making the big moves while you're sweating and saying, crap, I didn't expect that to happen. How often do you say, man, the market never did that before? It's almost like on a weekly or, semi-regular basis, right? It's about probably the same amount of percent there as the actual exceeds the expected. Like one in 5 days. Oh, I never did that before. And then it does it. And then you forget all about that. And then, a week later you say, man, that never happened before. Of course, it happened again. Will you ever learn? I don't know. Well, anyways, perhaps I should talk a little bit about our 0DTE now and go into that a little bit of detail. Let's see. We need to go to Trading View. Oh, by the way, do I have one of my accounts that I... Yes, I do. Let's check this out. And this is this one, yeah. So this is a campaign I ran for about a year and a half between mid-2022 to the end of 2024. And started with $23,000, ended up with about $50,000. These are campaigns people often wonder. They say, well, Ernie, if it's so good, why don't you just trade a whole lot more money? I do. I have a bigger account that I trade. These are the accounts that I show inside of my coaching service so that people get a feel for what is it like when you run a minimal size campaign, and how does that work? How do I size it? So if I just try to flex all the time, they're all going to get disillusioned about what is actually real. So here, these are the campaigns that I run inside my service. All right. Only a 48% win rate. Like, you probably say, oh, that sucks. Nobody can win on that. Yet, here's the proof. Have you ever seen an equity curve like that? I know you haven't. Max drawdown, under 6%. Most of the time, under 2.5%. Sharp ratio, 5.87%. Go look that up. Find out if anybody that you know, any professional trader, has a Sharp ratio of 5.87. All right? And this isn't a fluke. I can show you another campaign. Let's see, do I have that campaign running here? Yes, I do. And that is this one here. This is a campaign I ran earlier this year. And let me see if I can get that up on my screen so I can talk to it. So a little bit different. Now, this is not almost 500 trades. It's about 100 trades. I ran it in the beginning of the year until about May. And it's a slightly different strategy. You'll notice that the win rate is a little bit higher. And that's because I was focusing mostly on a before the market open trade called the big ass fly, and you've probably heard me talk about that. And so it's very different market dynamics, looking for a different type of payout, and it's still a 0DTE strategy. So it had more of those trades in it, so slightly different. However, you'll notice that the Sharp ratio is still up in the 5s. And again, the same kind of performance, bottom left, top right, with very little variance in it. All right. And I guess you could say if I had extended that out, my Sagar on this particular trade, on this performance, was saying that had I continued with this, I would have made about almost 80% on this over the course of a year. That's what your compounded annual growth rate was at. That's what this number is, way up here in the upper top area here. So there's two campaigns, and I could show you these over and over. This is tail risk trading. Super small risk, large potential reward, most of the time just going sideways. going sideways, then up, sideways, then up, sideways, then up. Never going down, right? That's how you compound over a long period of time. I don't know what better illustration I can give you. Actual trades, actual accounts. All of these accounts, by the way, I traded in front of hundreds and hundreds of people inside my service, showing my actual trading account, right? The actual fill orders, everything are recorded inside my Discord. So if you go in there, you could go back and you could see every single ticket for every single trade there. So this isn't just something I made up. It's not hypothetical. This is what we do. Now, admittedly, it takes a little while before you start developing the discipline, the temerity, the skill to do this on a consistent basis. And when you start going out to the further out trades where you're not involved in it as much, forgetting the 0 DTE to 0 to 2 DTE, go to 3 to 5 or 5 to 10, you can trade that in any kind of environment. There's a little bit of work to do, a little bit of macro analysis and that sort of thing. And that's where the AI comes in handy. It also helps keep your head on straight because it will help you reflect on the actions that you take. It'll be your sort of constant coach in your ear, right? So there you go. There was a couple of questions here, I guess. Please further define the expected move as charted. Is it plus or minus sigma or... No, expected move is like 1 sigma. So when you go into your Thinkorswim account and you see that light gray area for that day, that is essentially the expected move. All right. Is that 100% from the 0 DTE OTM flies, or does that include your fat tail trades? No, that's all 0 DTE stuff. The fat tail trades, we just started this up because I wanted to show people that there's an extension to the all this tail risk trading, and people have been. What had happened was I first introduced this about 6 months ago, and one of our members went and took a trade that was similar to what I'm describing here. $130 bet made $6,200, right? And he goes, "This stuff is unreal." I said, "Yeah." And then other people wanted to know about it, so I started to introduce it. And then bring them to the realization that our 0 DTE trades were, in fact, fat tail trades too, just in a smaller time frame. So now we're expanding out and adding that to our repertoire. So, yeah, that's it. Well, thank you very much for the comments. And I hope you all have a great weekend. This is Coach Ernie, and I am out.